Hello, how are you doing? Welcome along to FTUK's weekly catch-up live stream. Hope all is well with you wherever you are in the world and your trading week has gone well. Things are pretty good in the UK because it's so nice and warm and sunny, and I love the summer weather. So I hope things are going well wherever you are, and your trading week has been a successful one. Busy week at FTUK. Yeah, we live in busy times. New products and services as well coming our way very soon, in a month or so, something like that. I don't want to get into too much detail. But yeah, if you've never subscribed to our email list or onto our Discord, make sure that you jump over to Discord and join the community, because that's going to be the first place you're going to hear about anything that we're doing at FTUK. Yeah, super exciting things in the pipeline. Lots of big payouts going out as well at the moment. So some very happy traders out there, and it's been a good year in markets. Let's be honest, it's been a great year in markets. Also, as well, if I could please very graciously ask you to subscribe to our YouTube channel. It's going quite well on YouTube. We are starting to grow nice and steadily, and it's good to see our quiz questions. If you've never seen them, there's a lot of people love it. There's a lot of people answering the questions, so it's a really good bit of educational value if you're developing as a trader. Subscribe to the YouTube channel, and then it'll come up with a notification during the day to tell you this new question. And it's just we're not selling anything. It's just a bit of extra knowledge and information just to keep you thinking about your trading, and give a bit of value to everybody. So yeah, it's good to see. Right, so what we're going to do today, I'm quite looking forward to this session actually. We had some questions discussing CFDs from some customers early in the week, so I thought it'd be a really good idea to go through some of the details of CFDs. That's what we currently offer. We are a CFD prop firm, as all prop firms are really. We deal in CFD contracts, and it's surprising how many traders don't understand CFDs. And then they're a bit weird, but they're not that complicated. You just need to spend a bit of time going through them. So I'm going to do a little mini workshop, just a simple one, nice primer, going through the key differences between CFDs and Forex, and hopefully if there's one tiny thing in there that you haven't considered, then that will be worth doing for sure. I also want to talk about how markets will change, or potentially traditionally are expected to change over the summer months. They do. There's probably not quite as much in this as there used to be, but it's still an interesting point, and you can get some differences because markets are made up of humans, and humans have a sort of seasonal cycle as well. When it's sunny, we don't tend to want to do any work. We always want to go outside, so the summer months do have a sort of impact on our behavior, or our sort of like our positive feelings and stuff, and therefore that gets fed into the market, or it certainly can do. So I want to discuss that, and also I want to look at a new review, or an updated review that we've got on one of the major review websites. That's ForexPropReviews. I want to just highlight it. I think it's looking good, and I think the guys have done an amazing job with it. So yeah, I want to touch on that as well. So let's jump in and let's start talking about CFDs. Let's run through this first. I found 7 key differences between what we would describe traditionally as Forex, and also what we would then compare Forex with against CFDs. Now, CFDs obviously stand for contracts for difference. What is going on in that? Well, CFDs are, I think, don't quote me, but I think they were originally invented by Merrill Lynch in the 70s or 80s, something like that. And they were instruments that are basically, everything you do in markets is always to do with contracts. You're entering into a legal contract with another party, and in the case of a traditional broker, what you're doing is the CFD is a rolling contract every 24 hours, essentially, that allows the broker access to the funds that you deposited with them, and you're giving them permission to either put into your account the difference in the price in your positions at the end of the day, or extract the money from. I mean, that's kind of it. And they just keep going and going and going and going. That is essentially it. Obviously, when you then attach leverage to that and you trade on margin, it gets a little bit more complicated, and that's why they're considered to be high risk ways of interacting with the market. It's certainly not the same as putting your money into just a bog standard savings account, but that's what they are. That's what the CFDs are now. The actual type of instrument, the movement in price of the underlying asset or commodity. And this is the important point. A CFD really represents something that is underneath it. So we're not just trading a moving price. You've always got to remember that there's something that price is based on. a bar of gold, a barrel of oil, a sack of coffee, or something, or a bushel, as the phrase goes. But the point is that there's always something underneath it. Whereas with foreign exchange, what you're always looking at from a price point of view is an exchange rate between two things, two different currencies, and the exchange rate tells us what one currency is in value against another. So it's very, very clear difference between them. Second thing is pricing, how pricing works. Now with CFDs, the price, we always look at CFDs in terms of the price of a contract, because they are a contract for a difference, and we standardize the sizes of that contract. So in the world of CFDs, generally across the board, one contract will represent a certain amount of that underlying asset. One contract will represent X amount of gold, or it'll represent X amount of crude oil or natural gas or wheat or whatever it is. But that is very, very important to understand. Whereas with Forex, the actual pricing of Forex is always based on the smallest amount in the exchange rate, and that's called a PIP, or price interest point, and that is the fourth decimal place in the actual quote. So you'll always go onto your platform and you'll see things that the pricing always looks really, really strange. And with currencies, we either quote the currencies to 4 decimal places, a PIP, or if it's where the dollar is the base currency, that's the front part of the currency quote, you'll see that in the things like the Japanese yen. We quote them in digits of 2. But the point is the PIP itself is what drives the actual pricing. So in Forex, one standard lot equals 100,000 units of the base currency. Don't need to go into more detail than that. This is just an overview and a comparison. But the key point is that we're showing you that there is a difference between the two. Now, when it comes to the actual sizes, it's always going to depend on the asset itself. So the gold, the amount of gold that makes up the units of one contract in the CFDs may be different, and it is different from that of another commodity. Whereas in Forex, everything is unionized across the board. So the standard lot sizes that people trade, and then the divisions of those are fixed for all of the currencies. It's not like that in CFDs. So this is why you'll start to see the prices are very, very different on the actual trading platforms. So if you look at the contract sizes for some of the major CFDs that are traded out there, so if we look at gold, one contract of gold represents 100 troy ounces of gold. So therefore, a $1 move in the price would equal $100. That's how that works. Natural gas, though, is very, very different. It's priced in BTUs, which is the British thermal unit, and one contract represents 10,000 MMBTUs. And that in itself, when you put that into the actual movement on the price chart, just a 1 cent move will equal $100 in movement. So you can start to see how vicious natural gas is in comparison to gold, and gold is a vicious market. There's an old thing I remember years ago. Natural gas has the is affectionately or unaffectionately called the Widowmaker, and there's a reason, because it is just so vicious, and that's the reason. You can see, because it is so volatile on the actual amount of movement in the price if you trade standard size lots. Look at crude oil, though. That's completely different altogether. So one lot in crude oil in the CFD world equals 1,000 barrels of oil, and so therefore a $1 move in the price would equal $1,000 in movement. So you see that how they're all slightly different, and this is why when people go in and they start clicking the button, they can't understand why their account is moving faster or slower. Yeah, so it's really, really difficult to get your head around it, but it's understanding this that's going to help you. Coffee, there's another example there. Coffee at the bottom as well. That's 1,500 pounds of coffee makes up one lot, and therefore a 1 cent move equals $50. So understanding that is always going to help you as a trader. Yeah, obviously the platforms do a lot of automation for you, but it is important to understand. Now, when it comes to Forex, you'll see that it's a lot more standardized. So you'll see on the left hand side there, we've got what you would describe in the MetaTrader world as your basic trading sizes. That's your standard lot, 1.00. Most traders traders will be used to understanding what that means. But do they actually understand what it means? Well, yeah, that's the 100,000 units of the base. So when a currency pair like euro dollar, that's 100,000 euros converted into dollars, whichever direction that you're going in, yeah? But that is what that means. Now, in Forex, we then divide that size down. And the standard way of doing it is divide it into 10 and then divide that 10 into another 10 as well. So say, for example, if you were looking at 0.10 lot size of the dollar against the Japanese yen, that would equate to $10,000. If you were then dividing, you're looking at the pound against the Swiss franc, and we traded the smallest amounts possible, which is the smallest amount that you can trade with any broker or any prop firm. That would be 0.01, and then that would then be the equivalent of £1,000. Priced in Swiss francs. So you see that there's a massive difference there between the CFDs and then also the Forex as well. What about margin? Well, obviously, we're always trading on margin. And margin is the same whether you're trading CFDs or you're trading currencies. But the key point to understand with margin is that the margin will always be dictated to you by the broker for CFDs based on the size of the position that you've got in the underlying market. When it comes to Forex, you do have that percentage. That is important, but it's always going to be much more compressed, and therefore you're going to find that you're going to have a lot more firepower. The leverage is going to be higher. So you'll always find that leverage is quoted by most brokers and prop firms based on Forex, but usually CFDs are a lot less, and it's because of the extra volatility that is in there. But yeah, that's very, very important to understand. The next one, the fifth one, there's a lot of these, isn't there? The currency conversions. Now, in CFDs, you usually price the CFDs. They're usually always, in fact, 9 times out of 10, they're usually priced in dollars. So the actual numbers that you're seeing move around on the screen are going to be dollar amounts. Now that's fine, that's okay, because most people will be working their accounts in dollars. It only starts to get a little bit more complicated if your account itself, if you have a retail brokerage account, is in sterling or is in euros or yen or something like that. But most people will always be having an account that's in dollars, and then they'll be trading products that are priced in dollars. Forex itself is much more simple because you are only ever looking at one currency based on another currency, and it involves those two currencies. The only complexity that you have in there is when that is then converted into another currency that comprises your account. But generally, everything is always in dollars. What about spreads? Spreads and swaps. Well, this is what I remember years ago when I first started trading. I mean, that was the go-to for so many people was evaluating broker to broker or prop firm to prop firm based on the spreads that you can get. Well, in CFDs, the spreads are going to be relatively standardized, and the swaps that you get, that's the money that's paid or you pay overnight to hold the position. They're always going to be based on some kind of metric to do with the underlying asset, whereas with Forex, those swaps are always based on the interest rate differential set by a central bank. It's really, really important to sort of understand that. So you will get those swaps on CFDs and on Forex, but they come from slightly different starting points. And yeah, that's a unique feature that is different between the two. Let's finally look, the seventh thing, let's finally look at profit and loss. Now, this is just a very, very simple, quick guide. I would highly, highly recommend that if you do not want to be confused and you want to develop as a trader, that you spend a bit of time over the weekend when it's nice and quiet and markets are shut, get a spreadsheet and start calculating these things out for yourself. I cannot tell you how much you'll benefit as a trader. You really, really take a big step forward when you feel that you understand what the numbers behind what is actually going on when you're hitting buy and sell. From the CFD point of view, the calculation is actually a lot more simple than it is for Forex, particularly if we just leave everything in dollars as well, because all you're really doing is taking the entry price and your exit price, whichever way around that you're going, you multiply that by the size of the contract that you are trading and then the number of contracts that you've got. Whereas with Forex, we've got to find out the actual value of a pip first and then multiply that by the lot size and then the amount of distance in pips that you're making in the market. Now, it's not that complicated at all once you've done this a few times, which is why it's a good idea to get yourself a spreadsheet or a pen and paper and run through it. So let's look at gold as a quick example here. So say, for example, that we've got an exit price and we've got an entry price. So maybe we went long at 3,300. That is dollars, obviously. So that's $3,300 per ounce. And then we came out of the market at 3,324, which is, I think, is roughly where we are today. So that's a $24 move. Well, we know that we need to multiply that by the contract size. So what is our contract size? It's 100 ounces per contract, yeah? So if we trade one contract, all we need to do is multiply the 24 by the 100, and obviously then the number of contracts you've got, which is 1. So that would give us a return on that, a profit, a dollar amount profit of $2,400. That's it. It's really, really simple. And if you then wanted to divide that down, so for example, you then traded 0.50, so half of that size, you would just halve that. Yeah. So it's not difficult to work out. So with like $1,200 instead of $2,400. So it's a very straightforward, simple calculation. And once you know, let me just go back to it. So once you know all of these, and you've been through it, and you can find that stuff on Google, it's really, really easy to find, then it's dead easy, dead quick and easy to actually calculate these things out. Forex in itself I don't think it's too complicated, but it just takes a little bit of practice. The only complexity that you get with Forex is when you then start doing conversions with cross currencies that don't involve the dollar, but your account is in dollars. That's the only thing you need to pay attention to. But essentially, the basics, if you've got a dollar account and you want to convert, you want to find out the P&L on something like euro dollar, we just need to find the value of 1 pip, and then you divide that by the FX rate. So euro dollar is around about 112.54. Remember that 4 digit there? That is our pip. You'll always see FX quotes on pretty much all trading platforms quoted in 5 digits, and that's a fraction of that pip. That's all that basically is. But essentially, if we keep things simple, just work on that value. So that's 1 pip, which is that 4th decimal place there, divided by the FX rate, and then you multiply that by 100,000. That's going to give us this number down here. Yeah. That by 100,000 gives us a pip value of $8.89. So once we know what the actual pip value is, all we do is we take our entry point, exit point, figure out how many pips they are, and then multiply it, and then you've got your dollar value amount. So say, for example, we had a trade in this 112.50 area, and where we went long at 112.00, and then we came out at 112.40, so we made 40 pips. You multiply it by that pip value. So each pip is $8.89, and that gives us a profit of $355.60. So yeah, this is the sort of thing that the platform does for you. But when we get people writing in saying that they don't understand why this has moved very quickly and it feels different in price movement, it's because of the understanding around this entire subject. So CFDs and Forex, they are the core bits that all platforms are going to offer you, but the mechanics underneath are slightly different, and you'll always benefit as a trader by putting some work into understanding it. So yeah, it's super, super cool. Really, really good stuff. Okay, let's move on, and let's talk about the summer trading, because we are coming up to the summer. It's the 9th of May, and it is starting to feel quite summery. And if this is your first year in the markets, you're gonna get used to the fact that markets don't consistently operate the same way month to month, year to year. There is a seasonal factor in there, which you do get used to, but it's going to take you 1 or 2 seasons, maybe a couple of years to really tune into it. And you'll make mistakes as you're doing that as well, because the texture of the market does feel like it changes. If you've not experienced already that different markets have their different personalities, which is why people always end up specializing in one particular market, you'll soon see that, because you get used to that personality of one market, and then during the summer months, something feels like it's changed. You're not quite sure what it is, and it's usually because there's a seasonal factor in there. So the summer does have some sort of an impact on markets. And there is a book, if you've never read it, if I got it here, I got it out this morning, and this is which will really help you understand the seasonal factor. And it's this one here, and that's the Reminiscences of a Stock Operator, which is the book, very, very famous book. Everyone should have a copy of this. And it's the book that was written about Jesse Livermore. And one thing that is very clear in here, as he goes through his trading campaigns of his stock operations and stuff, is that he does take breaks from his trading, and he goes away and he travels and he comes back, and and he's always sort of like around the market, but he's there's a seasonality to the way that he's doing it. He comes back and he works, and then he goes and he takes a break and takes a holiday. And that is I remember reading this for the first time and really feeling, okay, if he does it, that must mean everybody does that. And what that means is it means that the human beings that make decisions in markets, they don't operate the same way all year. Why? Because we all want a holiday. Yeah. So that factor is very, very important. And when I read this book for the first time, that's when it really dawned on me that, there is a pattern to a sort of underlying current to the way that markets tend to trade. And this is what is meant by markets changing over the summer. So it's the human beings that essentially create that ebb and flow in the markets. And, when it's during, we all work very, very hard after Christmas, don't we? We'll come back and jump into the office and, get some serious work done. And then it's Easter and everybody takes some time off with their families. That's basically all it is. Now, it doesn't mean to say that things are dead. Quite the opposite, actually. You can get a lot of activity. I think when this book was written, it was a lot more pronounced than it is these days because of the way that the technology is. And, markets are 24/7 essentially. And there's so many computer algorithms in the market as well. So it doesn't necessarily change as much as potentially it did 50, 60 years ago, but it's still something that you need to be aware of. And I will explain why you need to in a second. So if you had to boil it down, if you had to come up with an answer of how this would look, what would that be? Well, I would say, I've been trading many, many, many years. I would say that generally, if you have to come up with some sort of a loose framework, January to May is your core window. And then from May onwards through to June, July, into August, late August when you get those US holidays before the big banks and stuff come back in September, that window is what we would describe as the summer. And then from September up to December, that's your final run into the first 2 weeks of December before the Christmas break. That is your core time to make a decent return. So if I had to choose, I would say that that's essentially the seasonal factors in markets, January to May and then September to December. Now, what's happening then from May to September? Well, it doesn't mean to say that markets are closed. They're obviously not, and there's activity there. But it's not that there's no traders there. There's everyone essentially carries on trading. But if there is an impact on the summer months, on volatility, on prices, on markets, that's essentially the window is going to occur in. Now, I remember when I first started trading, I had a lot of sort of like friends that were working in the city and people were working in investment banks. And I always thought it was so strange. You come across this terminology online and on Bloomberg and CNBC where saying that all the big players, they've all gone, they've all left the market. They've gone on their summer holidays. Well, I knew lots of people that worked in the city, and they didn't get all summer off. I mean, who does these days in any job like that? No one gets that kind of time off. So that in itself is saying, okay, well, it's dead over the summer because everyone's gone away. It's just nonsense. And even if people do have an extended break, then they're usually the algorithms and stuff that are driving liquidity in the market, that just carries on. It doesn't change. So I don't really genuinely believe in that. I mean, most people had to book some time off 2 weeks. And anyway, there's lots of people in these big banks and these funds and stuff. So it really doesn't make too much of a difference. So this concept, this is a very, very old adage, and it probably comes from this book, and that is sell in May and go away. The idea being that the market quiets down, everybody just like dumps their positions and takes a break after Easter, after that first busy quarter. You'll see that on CNBC and Bloomberg. Now, is it true that you should just basically sell all your stock portfolio and then just go away, or hedge it or protect it, something like that? Probably not. I wouldn't have said so. I would say that the effect of that is very, very marginalized these days. But it is worth remembering that essentially at some point in the year, you should be taking a break. And if you're taking a break, everybody else is going to as well. And because markets are moving en masse with lots and lots of people, that groupthink has that can have that effect on the on different markets and on the price action. So what actually changes? Now, this is the important bit. This is the really, really important bit. What actually changes is many people will get confused because they'll think that when the markets are supposedly supposed to go quiet over the summer, that equals that the markets are not going to move. And that is absolutely not true. Just because a market is potentially lower in liquidity usually means the opposite. So from a price movement point of view, you can find that the summer months can be quite high in volatility. And if you were to go back historically and look, you will see that the texture of the market over the summer can change in all kinds of markets, depending on what it is that you're trading. And therefore, less liquidity means you've got thinner markets, and therefore it doesn't take as much movement, as much impact on the market to actually move the price in quite a meaningful way. And without that, that's where you can have moves in markets that are very, very difficult to explain. They're not easy to actually understand because of the thinner conditions that are out there during those times in before Easter, and then in that run up to Christmas. You have huge amounts of money going in and out of the market. That provides stability on the price action. So if there's one inherent quality which I think does exist today in summer markets, it's the fact that the market can move in a way that you find a little bit harder to explain. And that's why I put it on this slide here. You'll find that some of the moves, if you can't explain it, if it doesn't feel, you've been trading successfully all year up to Easter, and all of a sudden you can't explain why this happened or that happened, it can be that seasonal factor. That's the important bit. What you need to do as well is, as you're monitoring your strategy on a week-to-week basis, on a month-to-month basis, if you start to see any change in performance, that can also be a part of the change in the change of liquidity into the summer months. It can impact your strategy, and that's something you need to cater for. That's something that you need to understand, and you need to be prepared for, because what's the worst thing that can happen by not understanding the potential for a change in the summer is you have a great run up to Easter and everything's working great. You're sort of patting yourself on the back and you feel good, and you carry on trading without an awareness that that's going on, and your strategy starts to fall over, and you actually bleed back into the market all of your good work from January up to May. That is just one of the worst things that can happen. It can really make your year difficult, because then you've got it all to do again when everything gets back to normal in September. Now, one of the things that I would say is very, very important when you're trading is to know whether you are in sync or not in sync with the market. After all the years of me doing that I've been doing it, I've always felt that I'm more in sync when the bigger players are there, because I can rely on the information, I can understand the analysis, that I know what the market should be doing from a price action point of view. So therefore you can search out the trends, you can search the direction out in a cleaner fashion, and there you feel you get some confidence from that. That gets a lot harder to do during the summer months when there's moves that you can't explain, so you can start to feel out of sync. So that in itself alone is a reason to just take a step back, and that's really the answer. What should you do? Well, you can carry on trading, and most people do. The markets definitely do not shut, and the opportunities are there. And certainly, if you've got thin markets, then you can make your summer a fantastic summer. But just be aware of it, because if you are at all in doubt, the simple answer is this, and that is step aside from the market, step aside from the price action, take longer extended breaks, come back, reassess, and then take it from there. You always remember that you've got an entire year to put together your trading performance, no matter whether you're doing it in a in a scalping strategy style, or a swing trading style, or a position sizing, or a big position long-term type of trading strategy, you've got that whole year to actually get that performance in. And there's nothing, like I said, there's nothing worse than really sort of having a good start to the year, destroying it, and then really having to work incredibly hard into the end of the year. And remember as well, if you do take a break over the summer, that the opportunities are still there, because once the big players come back at the end of August into September, all of that price action is still there, and the opportunities are fantastic, and that can really make your whole year. So relax. That's the cool thing about it. Good stuff. So that's a good look at some detail around how trading changes over the course of the summer. Now, finally, I want to talk about ForexPropReviews. There's a lot of review websites out there, and the prop industry is full of these kinds of companies that review different websites, then they comparison websites, so that people can make different choices and compare one prop firm against another. A lot of these sites, particularly the really good ones, they do a great job. And we've had been listed on ForexPropReviews for a number of years now, and they recently revamped all of their listing for us. And I wanted to just show it, because I think they've done a really good job of it. And it's something that is brings up an important point, which I think is something that you should be aware when you are evaluating prop firms. So let me show you it on the actual website itself. I'll get the right button on there. You should be able to see it here in front of you. Yeah, so there it is. So we are on their list. I think where are we? Number 14 down there. So you click on that, and obviously you go to our page. This is what's all been redone now. It looks really good as well. Now, up until when this was done last week, this had a lot of old information on there, and so it really needed redoing from a point of view. There's been a lot of changes at the company. We're always changing the products, the website changes, the offers change, the pricing changes, all sorts of things change, and it needed doing. So they've done a good job of getting this all up to date, so it's all perfectly relevant. And what I do like about these websites, if you are in the market looking for a prop account, because there's so many prop firms to choose from, is a lot of them do a very good brief summary. So if you wanted to find out everything about FTUK and you were to go on our website, yes, it's all there, but it is nice when you see websites like this that give you a condensed summary. They really condense all of the information into one digestible format where you can get all of the answers that you need. They'll give you a score, they'll talk a little bit about it, give you the prices, the scaling, how it all works. It's all there in one place. You don't need to dig around too much in the FAQs and that kind of stuff. And it's understandable, because as a company, we have a big website, we have a lot of information in the FAQs, and we can't just condense it all down to one page. So the way that these review sites do it, I think, is particularly good. But the point that I wanted to make with this is that up until the last few weeks, this needed updating. So what it means, when you go to these websites, if you do look at these kinds of websites, then don't be always remember that the prop firm itself might be slightly different from what they're saying, depending on when it was last updated. Now, the thing that one of the things we're trying to do over the summer is that we have no control over how many of these websites are set up, and anybody can set up an affiliate comparison website, and lots of people do. But as a company, and this will be the same for all prop firms, we don't have control over that. In fact, there's quite a lot of instances where we don't even know that we've got a review out there. So if you do see anything online, it can be some of the information that's wrong. Don't necessarily think that means that there's a problem. That's what I'm trying to get at, because it's not. It's just that it's such a difficult thing to keep on top of. But what we try and do is we try and keep on top of the really big guns, the guys that are out there we know about and we've got a presence with, and then we keep them updated with the right kind of content and information, and keep that communication open. And it's definitely a good thing to do. So always just bear that in mind. And if you do see anything online which you think is inaccurate about FTUK, then always email in, and we'll get the team across it and get everybody looking into it, so we can get things fixed and things changed. But yeah, it's a really good snapshot of exactly what we have got on offer at FTUK. Although I suspect that within a month or so, it's going to need some more updating, because there's some new changes coming as well. So but it's good to see. Okay. We are near the end. A lot of detail in today's live stream. A lot of detail. And yeah, finally, we will close with our May offer. We've got a good offer on at the moment on the website. 25% discount. Obviously, the offers change. We have some barnstorming offers over the last month or so. This is a decent one, so take advantage of them while they are there, because they do change frequently. Sometimes they're better, sometimes they're not quite as good. This is a good one. It's a good, healthy, good one. And it depends how you want to trade, because the offers that are wrapped around the discount as well, it can be useful to you. Sometimes we offer more drawdown on the accounts, or buy one get one free. This May offer, you get a 25% discount off all of the accounts, the instant funding, and also the challenges as well, the 1-step and the 2-step. But with the instant funding, you get the payout booster. That's not extra profit share, it's an extra boost to your payout that you actually get. So bear that in mind. But it is definitely useful to have because it's instant funding. So why wouldn't you want that? It's very, very popular. The challenge accounts as well, you get the level 7, which is normally charged as an add-on, that is thrown in there completely free of charge, so that you can stand the best chance possible to scale up to those heights if you're able to do it. Great offer. That will be there all weekend, 25% off. Make sure you take advantage of it. That's it. That's everything we've got for today. Thank you very much for joining us. And yeah, any problems, always reach out to the team. They are always there to help. And we really appreciate your support as always. Thank you very much for watching. Have a great weekend, and we'll see you all next Friday.